Yeah, welcome to the second lecture of mine. The title or the paper that we go through today is entitled, the short of it, Investor Sentiment and Anomalies. But before we will discuss or before we go through this paper, some administrative things that I would like to mention. First of all, tomorrow we have this guest lecturer coming here from Estlanders and Partners. And I think it's directly after my lecture. So from 10 to 12 tomorrow, I have the lecture, and the lecture will take place in Wolf. And then from 12 to 2, Daniel is coming and gives you about 2 hours of lecture about what he's doing in hedge fund management. He's working in hedge fund management or as an analyst. So quite interesting. I've seen it a couple of times already. And yeah, then you will get basically some practical insights, what you do. And he will also talk about momentum. We will talk about momentum tomorrow, exactly before his part. So it might be quite interesting for you to get some practical viewpoint as well. Otherwise, my colleague who gives the exercise sessions, he has booked her exercise sessions on Monday, next Monday. It's from 10 to 12, and not from 16 to 18, like it has been previously, okay? It's the group 1, next Monday, from 10 to 12. Just that you know. So this paper that we go through today, the short of it, Investor Sentiment and Anomalies. So what is this paper about? So just to give you an overview, so this paper is about the investor sentiment index, and the idea is that investor sentiment has a component that drives basically, or that has an impact on the whole stock universe at the same time, that basically drives the evolutions of many stocks at the same time, and this concept is combined with the idea of short sale constraints and impediments to short selling, so that people basically do not sell their stocks. The people tend to keep their stocks and those don't sell them. So first of all, the idea that that investor sentiment has one component that drives all stocks, combined with the idea that we face short sell constraints in financial markets. Now that's the idea. And what they are doing then in that paper, just to give you like a basic idea, they they investigate 11 different cross-sectional asset pricing anomalies, and they compare the payoffs when investor sentiment is high, so when investors are very optimistic, maybe even over-optimistic, with the payoffs when investor sentiment is low. Yeah? And the payoff differential should be positive. And since we are dealing with short sell constraints, we have overpricing in the markets, which means that the short side of the strategy should respond, but not the long side. Yeah? But this is what we will elaborate during the lecture more in detail. And what they find is basically for a whole bunch of these 11 anomalies that they consider, many of them basically respond to changes in investor sentiment. But some don't. Most do, but some do not. That's basically the outcome. So therefore, they conclude in the end of their paper that investor sentiment may be a partial explanations for a whole bunch of cross-sectional asset pricing anomalies. Any questions so far? That's the basic idea. So if we just go directly to the motivation of the paper, so I already mentioned this here. So I have this draft. I made some comments and I highlighted some things that I think are important. I have not done it at the paper yesterday, because yesterday I was using some sort of, I highlighted some things with a marker, and a couple of terms ago some students were complaining that you couldn't see it and so on and so forth. So that's why I just use now this simple pen here for highlighting some things. So here I already said that the concept of investor sentiment contains a market-wide component with the potential to influence prices of many securities at the same time in the same direction. So some investors are unwilling to sell short or have impediments. They can't, maybe. For instance, if you remember in the financial crisis period, probably you don't, because it was 10 years ago and you have been something like, 13, 14. So 10 years ago, but you can ask your parents, maybe they know. So when we had this financial crisis in 2008, 2009, 2010, this was roughly the period, then people could not sell, for instance, as far as I remember, people couldn't sell banking stocks, So certain stocks that you have in your portfolio, you couldn't sell in the time when you actually would need it. So there's, of course, some empirical argument for that claim. And this, how they say, will in turn lead to a few investments being overvalued. Yeah? So what we have here is overpricing. And in order to understand, in order to grasp the idea, what's going on here, so we have to think about the concept of overpricing and underpricing. Yeah? And I have this hand-made notes here. So if you have an investment strategy, and you finance your long side by selling stocks short. Yeah? You sell stocks, you get money, and then you take that money and buy other stocks. And the spread, so the difference in returns from one period to the next is your profit. Yeah, that's the idea of hedge funds, and that's the idea of creating zero-cost strategies or zero-cost portfolios. Yeah? So, but there are three different ways or three different possibilities how a zero-cost strategy can actually work out. Yeah? Or how the profit of a zero-cost strategy can actually be generated. And these three ideas we will briefly go through in order so that you understand what's going on here. So first of all, the most intuitive idea is, you have stock 1, and this stock, you want the stock to decrease in the next period because you sell that stock. So you are short. You're short in stock 1. The price of stock 1 at time t minus 1 is 11. You take that money and buy stock 2. Stock 2 has a price of 9 at time t minus 1, and you are long, so you buy that stock. Yeah? So at time t, the first stock that you are selling short decreases from 11 to 10, and the second stock that you are long, so that you bought in your portfolio, increases from 9 to 10. So your profit is then the long side minus the short side. Yeah? But since the short side has a negative return of minus 1, your profit is 1 minus 1 is 2. So you have profit of 1 minus 1 is 1 from the short side, and profit of 1 from the long side. So the total profit is 2. I think that's clear, right? No big deal. So second possibility, what happens here? We again, if we implement a long-short strategy, we have two stock positions, long and short. And again, we are short in stock 1 and long in stock 2. What happens here in this scenario? Well, the first stock decreases from price 11 to price 10, and the second stock does not change in its price. So what about then our profit? So we buy the stock 2, but there's no change in price, so the return is 0. And the second stock that we are on this, and the second position, our short position, changes from 11 to 10. So since we are short, we have to subtract it, and the return is -1, so it's 0 minus -1 is 1. So 1% return, or one unit return, and it's due to the position that we have on the short side. So the overall return of our zero-cost portfolio is related to the short side in this case. Yeah? And then finally, the third and last possibility is, again, we have a zero-cost portfolio, Samayutto, in the setup, okay, as we can say. So, and then we have here the first stock. Now it's the short side that doesn't change, but instead it's the long side where we have a stock we have an increase in prices from 9 to 10. So our overall portfolio return is then 1 minus 0, because the short side doesn't change, so the overall return is 1, and devoted, or you can trace it to the long side of our strategy. Yeah? So 3 different possibilities. And now my question is, which of these possibilities do they test in their paper? It's that one, overpricing. So whenever the return of the strategy can be traced back to the short side, because the short side is responding, then we are dealing with overpricing. So it's basically this what they test. And that's also the way how they formulate the hypothesis if you go carefully through the paper. So the first hypothesis, what they test is that the long-short portfolio is depending on, or basically changes with changes in investor sentiment. So the long-short portfolio responds positively to changes in investor sentiment. So the second hypothesis is then the short side response. And the third hypothesis is the long side does not respond. That's simplified what the hypothesis is. So 3 different hypotheses that they basically go through. And they test these 3 hypotheses for 11 different anomalies in their paper. Any questions so far? On page 290, in section 2, they come up with a motivation of their paper for why we have, or for why we have potential short sale impediments, and they are referring to a paper from Ritter from 91, as you see, and that periodic waves of optimism that especially impact the prices of young growth stocks. And then they argue in the next paragraph that many institutional investors, such as mutual funds, are simply prohibited by their charters from taking short positions, and so on and so forth. And all this is probably true, but I was wondering, when I read the paper, it wasn't that convincing to me. It doesn't seem to be, how to say, even though that's true, I have difficulties to buy that story. That this really impacts the prices so much, and then of all the stocks at the same time. So there's certainly some truth in it, but I'm not 100% convinced by how they sell the paper, to be honest. But well. And next. So as we already figured out, it's about investor sentiment and what is investor sentiment measuring. So it should measure the optimism in the market, the optimism of investors. And here in figure 1, they plot the index, the investor sentiment index that they use in their paper. And they describe in section 3.1 how they measure it. They use monthly market-based sentiment series constructed by Baker and Wörgler from the 2006 paper. The time span is from 1965 to December 2007, and so on and so forth. But the interesting thing is actually in the table description here. Yeah. So they use 6 different measures or indices of investor sentiment, and basically what you see here in figure 1 is the first principal component of these 6 series. Yeah. And what you see here is, when you are below 0, investors are more pessimistic, and if you are above 0 in this index here, then investors are optimistic. Yeah? And I was marking here in the paper because you can quite clearly see, for instance, in the 2000 period, yeah, when Nokia was exploding, yeah, the stock price of Nokia. So we see here in the 2000 there's a huge spike. So obviously investors have been very happy, and maybe too happy and too optimistic, because afterwards the crash occurred and stock prices were decreasing a lot. Yeah? And we entered actually a recession, a worldwide recession, yeah, in the early 2000s. So that's basically how these indexes look like. And there are many papers circulating around, and we will come back to that concept again. So principal component analysis is very important in finance research, and not only in finance research, but also in other fields of science. If you study psychology, you will face factor analysis, yeah, where you have basically, for instance, I don't know if you're familiar with the Big Five. It's the Big Five theory, to character traits like extraversion, neuroticism, agreeableness, and so on and so forth. So what they do is, they have 100 questions, and then people answer these questions, and then you see basically 5 clusters in this 100, among this 100 questions. So there's a core movement between certain questions in the sample. Yeah? So you try to reduce the dimension from 100 questions, from 100 different possibilities. You have basically 5 main clusters. And this corresponds to these 5 character traits that human beings may have. Yeah? And so in finance, we use a similar thing, but we call it principal component analysis. And it's a tool to reduce the dimension of stochastic processes, simply speaking. And because we will then encounter it again and again in this course, and maybe you will not also need it for research, who knows, maybe. So we will go through briefly the concept of principal component analysis. And I made you, on Moodle, you will see basically this this file. It's called principal component analysis, and you will not find this description in the internet. You know, if you Google it, you find many pages, and it may be even more confusing than explaining. But I tried in this description to write it down in an understandable manner so that you understand the key points. It's not so important that you really can do the math in detail. You know, I mean, I learned it when I was studying economics and econometrics, and I had many courses in mathematics, and I did all this stuff by hands actually, and it was good. It was good. First of all, you remember things. Second of all, you know what you do. So if you just, because some students, they are complaining, and they don't want to have the mathematics, and if you don't know the basics, do you think that you know what you do then later on? If your basics, if your fundament is already lacking, what do you expect? So having a good and well-working fundament is very important to do scientific research, and it's also important if you work in the industry. If you get a project that you have to run, and you report, you give a suggestion for your manager, you have to have a good. Your analysis must be proper, because if you do too many mistakes, you're out. So you have to know what you do. That's super important, It's not only you don't learn only for university stuff. You learn basically for your work life, and not only if you work at the bank. If you have read the guide that I wrote for you, you might have recognized that many jobs nowadays, if you want to work at Facebook or at Google, what the people are looking for are people who can handle data. This is what people need. If you know how to handle data, you get the job immediately. Since 2000, since like 20 years ago, the world has somewhat changed. We entered the information society. We have a lot of data available. People want to analyze the data. People are looking for people who can handle data. And in any field of science, you use basically the same kind of methods, the same statistical methods. You use it over and over again. And this is one of these methods that's used for dimension reduction, basically. I will take this away here now in order to give you like a visual, in order to visualize what I'm talking about. Make it simpler to understand. So we are dealing not with questionnaires, with a Likert scale of 7 items or 9 items. We have to do with stock returns. We are more interested in money. And let's say we have 3 assets or three stock return series, where this is the time dimension, and that's the return dimension. And let's say we have one stock is like that. There's a typical evolution of a stock return. What we have here, basically, this is then the average stock return of our first stock. And that is the evolution of the stock return over time. So sometimes you might have a return of +2, then you have a return of -1, and so on and so forth. So, but over time, the average return of this blue stock here, of our first asset, is this. Then we have a second asset, a second stock. And I'll use now green in order to highlight the return evolution. It moves maybe something like this. Again, same thing. So this is the evolution of the second asset over time. and the average is maybe, I don't know, maybe here. And then, for the ladies, I have red as well. Red stock, or third asset. And we have, again, a return evolution over time, and the return may be a little bit lower, maybe something like here, of our third asset. So we have a system of 3 assets, or 3 stocks. Yeah? And what we can do is, we can put this return evolution also in a vector, because we have the data. We have the data at hand. And then we have the first vector, where we have basically over time the numerical values of the returns of this first asset. Yeah? And we put it into a column vector. And we do the same for the second one. Also in the column vector, we have the same number of observations, and we put the numerical values of the return series in the second vector and put it to the second column. And we do the same for the third one. So we have 3 column vectors, where the first column vector corresponds to the time series values of the returns for the first asset, and the second for the second, and the third for the third. Yeah? So we have basically, what we have is a matrix here. This is a matrix, and it has a dimension t, because we have t rows for the time period, for the time dimension, and we have 3 assets. So n is 3 in our case, or in the notation of this worksheet. So what I can then do next, what we know from basic statistics, is we can subtract, we can standardize each series as well. This is pretty simple. So the standardized series, for instance, for the, let's take the blue one here. Let Z denote the standardized return series of the first asset. So what we simply do is we take the returns from the first asset and subtract the average return, yeah, divided by the standard deviation. And what we know is from statistics that this random variable, or this return process, is distributed with a sample average of 0 and the variance or standard deviation of 1. Yeah, and we can do this, of course, for all of these 3 series, and then we get basically a matrix of standardized return vectors. It's no big deal. Okay, that's simple. That's nothing fancy so far. But the idea is now that every single process here is driven by a deterministic term, which is in essence the intercept, yeah, the average return, and something stochastic. And that's basically what is in this worksheet here, given by equations 1a to c. We can break down every of this process here into a constant, which is a deterministic element of each process, and a stochastic component here. Yeah? That's exactly what we see here. And covariance stationary means that the process is basically, it's not like going like a random walk. It's somehow stationary. It converges to sort of a mean here. Yeah? It's not going around like a random walk here. That means covariance stationary. So now the question is, if we see the time series evolutions of our 3 return vectors here, the question now arises, is there maybe a common factor that drives all of these 3 processes at the same time in the same direction? Can we reduce, or can we describe the time series evolutions of our 3 assets by one process, for instance? The answer is, well, if these 3 processes, if these 3 assets are highly correlated, the correlation is like 0.9. So the higher the correlation between our acids, the better we can describe the time series evolution of our acids by one single acid, by the principal component, by the first principal component. If they are uncorrelated, we can't do that. If they are completely uncorrelated, which means that they are orthogonal, then each process can only describe itself. These are the two extreme cases. But in real life, we see something in between. Okay? But the idea is always, can we break down a system of equations, or a system of, in our case, of return process? Can we break it down, and can we describe it by the least amount of orthogonal processes? That's in essence what PCA is doing. Yeah, and I write it here. So, and how do we do it? What we do is we transform our original time series that we have seen here in equations 1a to AC. We break it down and formulate this system here of equations. Yeah. So there are basically, we transform our three processes into three other processes that are orthogonal. S1t is one process, but as you see here, it appears in all three equations. It's the same process. The only thing that is different is the loading against this process, so the sensitivity against this process here. But S1 is in all three equations. The same is for S2 and for S3. So we transform our time series here into three orthogonal series, and then we ask, what are the parameters that are necessary in order to describe our original processes properly? So from the data, we can't see these S1 to S3 processes. We can't see them, so we have somehow to construct them. So, and this is now what PCA is doing. It's pretty mechanically. There's no like big theory behind it. It's pure mechanically what's going on here. So every matrix, and you know this from matrix algebra, every matrix has eigenvalues and eigenvectors, corresponding eigenvectors. So in our case, t is larger than 3. So this matrix here that we constructed, irrespective if we take the original vectors or the transformed ones, so the maximum number of eigenvalues is 3 here. And if we use the transformed series here, then we can even say that the sum of eigenvalues must sum up to 3. Yeah? That's why we usually operate with standardized series when we do PCA. So I wrote here in this sheet an example how the covariance matrix looks like. So each of this, you can estimate the covariance process, the covariance matrix of these 3 vectors here. And it's a 3 by 3 matrix then, yeah? That's pretty much straightforward. So the covariance matrix has actually, in this case, on the main diagonal, we have the variance of the first acid. Then we have the second element on the main diagonal is the variance of the second acid. The third element is the variance of the third acid, and then we have here the covariance between the first and the second acid. Here we have the covariance between the first and the third acid. Here we have the covariance of the second and the third acid. And because the covariance matrix is symmetric, the same element appears on the other side of the main diagonal. Yeah? So, and in our case, because we have 3 acids, the covariance matrix is 3 by 3. So if these acids are completely uncorrelated, Of course, if the correlation is 0, the covariance is 0. And here, everywhere are zeros above and below the main diagonal. And if we have standardized processes, we know the variance is 1. So on the main diagonal are 1s. And what we get is this guy here. Yeah. But obviously, as you can already see visually, the way how I plotted the processes here, they are obviously not orthogonal. So there's a correlation going on. The other extreme is if they are highly correlated, so if they really move in the same direction over time. As an example, I can give you maybe a small example. This is the first acid. Then the second acid goes back exactly in the same direction. So when the other goes up, the second one goes also up. And when the other goes down, the other goes down as well at the same time. So in this case, the correlation is, the correlation is 1. Or close to 1. Let's say close to 1. And the covariance matrix looks like that. So if this is the case, like here, then there could be one process actually that drives all of these three at the same time. You know, we can reduce these systems of equations here, these three time series vectors, and we can substitute it by only one. There's only one element here that actually drives all of the three at the same time. And that's basically what PCA is about. So we can extract the eigenvalues of this matrix here, of the covariance matrix, and we sort them in an increasing order. And here in this case, if the correlation is very high, and the covariance matrix looks like this of the standardized series, so we have 1s on the main diagonal and 0.98 or 0.99 above and below the main diagonal. In this case, we have a very high correlation going on. So in this case, in this extreme case, the largest eigenvalue would be close to 1, something like this, 2.99999, and the other eigenvalues of the matrix would be close to 0 in this case. And this is a very extreme case, okay? We obviously do not observe this in financial markets, but this is just as an example. But in the other extreme case, like we had earlier, where the processes are orthogonal, where they always go in the other direction, the covariance matrix of the standardized series looks like this. It's an identity matrix, and in this case, we have all of the three eigenvalues are 1. They have the same magnitude, so they have no dominant eigenvalue. All of them are equal. But if we now go back to the other case that we just discussed, there's one dominant eigenvalue that is much larger than 1. So every eigenvalue that is larger than 1 is dominant, because we use standardized series, and if all of the processes are equal, all the eigenvalues would be 1. But if we have eigenvalues that are smaller than 1, they are not dominant. Only those that are larger than 1 are dominant. So if we have a system, let's say, we will later see in the paper, I will now move already a little bit forward, but if we have, let's say, we have 11 acids, and we do this PCA, and there are only 4 eigenvalues, if you break it down with the, we make the standardized series and then we compound the eigenvalues and we order them from largest to smallest, and we see that only 4 are bigger than 1. That means the whole system of equation, or the cross-section of these 11 assets, can be described basically by only 3 orthogonal processes that we can extract from the covariance matrix here.
3 or 4? You were talking about 4, I think.
4. It can be also 3. It depends on the data set. So there's a paper, for instance, if you consider the currency market. There's a paper from Lustig, 2011 paper. They do the same thing for the currency market, and they figure out that the whole currency market basically can be explained by they have only 2 dominant eigenvalues. So there are 2 factors actually that span the currency market, and that's the dollar factor and the carry risk factor. Yeah, it's very interesting. And they even found, if they do this PCA, they found that the correlation between the dollar factor and the first principal component, which is simply a really mechanical tool, the correlation is 0.99 or 0.98. So that's very interesting. So but people do it all the time in order to reduce the dimension of a system of equations. So in our case here, for instance, that I here just plotted here, we would have something like that maybe.
On the example, you said that they found the correlation between the dollar factor or something like that. Do you always try to find the correlation between the PCA one and some other factor, or can you just use the PCA one for?
It depends on the purpose. It depends on the purpose. It was, I don't know if this was coincidence in their paper, or if this was their intention. I guess this was more or less the selling point in that paper, at least. But of course, if you have a system, of equations or a system of assets, and you can show that one of these assets is highest correlated with the first principal component, it tells you something about the stochastic dependencies in the system. So it tells me, for instance, that this one asset that has the highest correlation to the first principal component is somehow the driver here, okay? Somehow the driver of the series. So, as I told you, if we go back, so the eigenvalues, we sort the eigenvalues from in a decreasing or increasing order, and each eigenvalue has a corresponding eigenvector. Yeah. So the eigenvector, in this case, we have 3 eigenvalues and 3 corresponding eigenvectors. Each eigenvector must have the same dimension like our matrix. So it must be 3 by 1. It's a 3 by 1 vector. And what we do is, so we get the eigenvectors and we multiply our matrix here for each point in time. We multiply it with our eigenvector and we get a new series. Well, what we get is then the time series. If we multiply our matrix here with the eigenvector, which has, let's say, S11, S12, and S13. If this is our first eigenvector corresponding to our first eigenvalue. So this is t by 3, and this is 3 by 1. So what we get is basically a time series that is t by 1, and this corresponds to our first principal component. So for our second eigenvalue, we have another eigenvector that and we can do the same thing. Then we have a second eigenvector, and put it here and multiply each point in time with this eigenvector, and what we get is we build a scalar product, and then we get a new time series for the second principal component. And we use also for the third, if we want. And then we get a third time series. So these 3 time series that we then constructed are orthogonal, so they are uncorrelated by construction. They are uncorrelated by construction. So what we have done then, we broke down our system here into 3 systems or into three vectors, time series vectors that are uncorrelated. And then we basically figure out the parameters here, how they load on these time series of principal components. Yeah? What's the sensitivity here of the first time series against our orthogonal processes, and what's the same for the second, and what's it for the third? So we have broken down the simple system here that we have given by equations 1a to 1c into three orthogonal processes that we extracted from the data. Yeah, that's what we have done. And the higher the correlation between the processes, the more important will be the first principal component, which corresponds to the largest eigenvalue. Yeah? So in this case here, there may be only one process actually that describes this time series evolution of all of these processes. And in this case, basically, we could skip the second and the third one here. They don't matter. So we would have only one process here that actually describes the evolution of all of the three processes in this case. Okay? This is clear to everybody. Yeah, so we will do it in eViews later on. We will do it in eViews in the exercise, in one of my exercise sessions that you have seen it, how it works. But that's the math, that's the idea behind it. That is the idea behind it. And that is good to have that in mind, so that you know roughly what you do. So, I mean, we don't have to solve the eigenvalue problems. I mean, I did it when I was young, and it was not so funny. And I think it's not necessary to do that, actually. But I mean, but what is necessary is that you understood the idea why you do that, actually, or how you proceed. So you can do exactly the same thing. You can do it in eViews by pushing a button, but then you don't know what you do. You just get some estimates, but actually you have no idea what's going on here. But once you grasp the idea, you can also do it in MATLAB and apply it to many different contexts and huge data sets. And this is also maybe something that we might do in my quantitative finance course. Yeah, so I will now go back to the paper. So that's exactly what they did. Oh, sorry, that was the wrong button. Cancel. So, and this is what they have done here. So they had 6 time series and all of the 6 time series basically were time series evolutions of different sentiment indices, and they took the first principal component, and this is what you see here. Yeah, that's what they have done, and we will see this again in other papers that we will discuss soon. So that's basically behind this figure. Yeah. So then what they, in section 3.2, they describe the whole bunch of anomalies that they use in order to test their 3 hypotheses. Yeah? I mean, you can go through that at home if you want. You know, maybe you think it's interesting. And yeah, just as a very short excursion here, this is what this is basically the time series evolution of different bond yields. Here, 3-year yields, 3 months, 1 year, 5 year. But what you see is here also, the time series patterns here are very similar. So you can bet that they share one common factor here. So that all these bond series, they are driven by one common component. So they have one dominant eigenvalue. There's one principal component that drives all of these series in the same direction. So this was just as a small example. Yeah, but let's go back to this paper here, finally. So interesting maybe here, they are also talking in the anomaly section about anomaly number 8. And we talked about it yesterday. Yeah, here it's called anomaly. Yesterday we had this topic as well, but yesterday it was a risk factor, right? You might remember that. Maybe not you, because you were not here. Yeah, okay. So yesterday I told you that sometimes people, they figure out new cross-sectional patterns, and then first it's an anomaly. And then after some time, they use it as a risk factor. This is exactly what was happening here. I guess the paper from Novimarx first started as an anomaly paper, and then in 2010, but we were reading yesterday the 2012 version, and in the 2012 version, it was all of a sudden a risk factor. Yeah, and this happens all the time. And the paper, what we will go through next week from Farmer and French, the 5-factor paper, yeah, they started in '93 with a 3-factor paper. Then they had in 2015 and 2017, yeah, they came up with this 5-factor paper. And now this year, 2018, they came up with a 6-factor paper, where they added the momentum factor to the 5-factor model. So, and the momentum factor is since many years well known as an anomaly. Yeah. So, and this happens basically all the time in asset pricing research, and it's actually a quite funny thing. So you can go through that by yourself if you want. So interesting table 1. Here is the first interesting table. It plots basically the correlation matrix of the standard return series here. And since the matrix is symmetric, they don't even report here the upper part of the correlation matrix, because it's exactly the same like the lower part here. So what they write is the correlation between the anomalies here is not very high. You see here figures from 0.47 between Olsen's O-score and failure probability. The correlation is 0.36, as you see here, between gross profitability and failure probability, and so on and so forth. Interesting, maybe in panel B and panel. In panel B, they report the excess returns, the simple raw returns minus the risk-free rate. But since we have, on the long-short, if you consider the long-short strategy, like here, long minus short, the risk-free rate, of course, doesn't matter because it cancels out on both sides. So, but it's here the T statistic is basically reported below the point estimate. That's a little bit uncommon and makes it a little bit maybe unusual to read, because usually you see the T statistics in parentheses, right? And you see then stars behind the point estimate. That basically tells you something about the statistical significance of the corresponding parameter. So this table is maybe a little bit more, say, difficult or more time-consuming to read. But, well, interesting maybe that, as you might see, the point estimate or the risk-adjusted point estimate of anomaly number 7 is the momentum anomaly. They have the highest point estimate here. Long minus short is 1.77 with the T statistic of 5.82. And that's the risk adjusted. In raw returns, we have, let's see, long minus short is here, 1.56 with T statistic of 5.45. So it's a very strong anomaly, obviously, and gives the highest payoff here compared to all the others. And as we will see tomorrow, hopefully, that momentum anomaly is a very stable pattern reoccurring across otherwise unrelated asset classes. Yeah. And also in our guest lecture, we will encounter this phenomenon again. So the risk-adjusted return, how is it defined? You see it here in equation 1. They regress the return series, each of these anomalies, on the Farmer and French 3-factor model, and then the intercept plus this error term here is the risk-adjusted return. And of course, in an OLS regression, this guy here is on average, it's 0. So the point estimate of the risk-adjusted return is nothing else but the average of this alpha here. So the paper is from 2012. At 2012, they did not have yet the 5-factor model. That's why they still use the old Farmer and Friends 3-factor model for risk adjustment. If you write your master's thesis nowadays, I guess you will do soon, hopefully. So then you deal with something like this, then of course you will use the 5-factor model, or because now it's 2018, so you will probably use the 6-factor model for your risk adjustments, yeah, if you do this risk adjustment regressions. So sometimes I get master theses. Sometimes master theses that cite papers from the 60s, from the 70s. What do you think I think if I read these master theses? Do you think that I get the impression that you made your homework? No, obviously not. So if you write a master's thesis, what you are expected to do is you are expected to be familiar with the most recent research on your topic. And many students do that as well. So many students, they write good master's theses. I have a lot of awesome master's theses. I just had an awesome master's thesis again, what I will publish in a good journal. So I have really, really good master's theses. But there are always these outliers, and then I'm wondering, sometimes I'm even wondering, did they actually study finance? So they write, they don't even know that the capital as a pricing model, that they use stock returns, instead of prices. So sometimes I'm really confused when I get some thesis. So I just recommend you, if you write your thesis, be careful. Be careful what you write, and think about my perspective as well, or the perspective of your supervisor. What he might think if he reads your thesis. And it's not only your supervisor who's reading your thesis, it's someone else as well. And actually it's the second reviewer who will give a suggestion for the grade. And then you will discuss, and then your supervisor and the second reviewer, they will discuss about the grade, what they think. So it's not so that your supervisor will give you the grade. It's two people. It's two people. So just that you have that in mind. So in what follows here, in the rest of section 3.2, they write about PCA, of course, again. So, and this is what they do. For the whole set of 11 anomalies here, note that the 12th row is a combination here of all of these 11 guys. But what they do is, for these 11 different cross-sectional anomalies, they do a principal component analysis in order to see how many factors actually drive these 11 processes. Can we break it down? And what we see here is, surprise, surprise. Yeah? For these 11 processes, if they would be uncorrelated, all of these eigenvalues would be on this line here. 1. Yeah? And each of the eigenvalues would explain, what do they say, 11% or something? No, 9.1% of the covariance matrix. But in this case, it's so that we have 4 eigenvalues that are larger than 1. And the largest one is, I don't know, what is it? 3? Something like that, I don't know. But only the first 4 eigenvalues, they explain the largest part of the variation of all of these 11 processes. So you can basically say that there are 4 processes, 4 orthogonal processes that drive basically all of these 11 anomalies. And this is not so surprising either, because if you now scroll back, We were talking yesterday, if you remember, yesterday, Novimax was investigating the gross profits to assets, earnings, and what else was it? Cash flow, pre-cash flow, something like that. So he was discovering three different measures, but all of them measure actually the same thing. And it's the same here. Return on asset, gross profitability, and return on equity, all of them measure actually the same thing. So of course they are driven by the same component. Yeah? And the same is for financial failure probability and O's and O score, all of these measures that somehow proxy for default risk, they measure somehow the same thing. So they are driven by the same driver, So that's why it's not surprising at all. Figure 2. So and now, the first interesting table is table 2. And table 2 is important. And there will be for sure coming up some questions in the exam. In one of the exams. There are 3 exams, right? So in one of the exams, I usually ask for this table. So I will put this here away now. So what I do is basically, for all of these 11 anomalies, let's say we have the return series of asset I at time t, and they regress it on a dummy. Let's call it 1t plus alpha 2i and dummy 2t. Yeah? So this dummy, they explain it in the paper also later. Yeah. So they have this, let's call it index. This investor sentiment index. Yeah, this is like this. And they compound the median. What's the median? Something like here. And then they compare, for each point in time, the value of t minus 1. So, for instance, if we are here, this is t. Here we have t minus 1. And they check, was the index at t minus 1 above or below the median? If it was above, then it gets a value of 1. And otherwise, if it was below the median, it gets a value of 0. Yeah? So it's a dummy. So this is the first dummy. So let's call it high. So the alpha 1 is a dummy for high, or it basically gives the sensitivity of asset I when we are in a regime of high investor sentiment. So the dummy is basically the 1t. It's a binary dummy of zeros and ones basically, and it's 1 if investor sentiment is high at time t minus 1 and 0 otherwise. And then they have a second dummy. A dummy is dummy 2 here in this case. And this is exactly the other way around. It's also a dummy consisting of zeros and ones. But of course, when the first is 0, when the first vector has ones, the second one has zeros, and when the first one has zeros, the second one has ones, because it gives you exactly the opposite, namely a 1 whenever the investor sentiment at time t minus 1 was below the index, the median of the index, and a 0 otherwise. Yeah. So this alpha 2 here is actually gives us when investor sentiment is low. Yeah, gives us the point estimate of asset I when investor sentiment is low. And of course, because we have a regression model here, we have to add an error term as well. So we regress it basically on two dummies here that give us high and low investor sentiment. We get the point estimates, we denote them with a hat, and then our first hypothesis, if this is the long-short strategy, so our first hypothesis is then that high minus low, so alpha 1 minus alpha 2 should be larger than 0. That's our first hypothesis. Against, okay, this is our null hypothesis from our first hypothesis pair. So the null hypothesis of our first hypothesis pair. And the second one is, the alternative hypothesis is then that it's unequal to 0. But actually, this is our assumption. But in statistics, we know that we have to change that our initial assumption we should formulate as the alternative hypothesis, okay? Because we want to reject our initial hypothesis. So actually, we have to change the pair. So our initial assumption becomes actually the alternative hypothesis, right? And the null hypothesis is then this. This is how we do in statistics, because we want to reject the null hypothesis, okay? So that's what we actually do. So, and what's going on here? Let's check the first one, failure probability. So they say, if the hypothesis is true, if their initial assumption, let's say, is true, then the zero cost strategy, so the spread, which we find here on the right-hand side of table 2, high minus low is the difference of these 2 point estimates here, of alpha 1 minus alpha 2. So this should be larger than 0. If the initial assumption is true and the zero cost strategy would respond to changes in investor sentiment. So, and yeah, our null hypothesis is, at least if we express it in statistical terms, our null hypothesis is then that it's, it's 0, right? That's 0 against bigger than 0. So, and what we see is the point estimate of the return difference between high and low sentiment is 1.96% per month with a t-statistic of 2.72. So what we can do is we reject our null hypothesis in this case. We have to reject it, which is good because we wanted to do that because the point estimate is statistically significant. So it's really larger than 0, which is in line with our initial assumption. So the second hypothesis was that it's the short part of the strategy that actually responds. So the return difference between high and low sentiment should be negative. So what do we have here for failure probability? The point estimate for high sentiment is minus 1.10, minus 1.25, which is the point estimate for being in low sentiment. So the spread, the difference is minus 2.33, and the t-statistic is minus 2.6. So minus 2.6, as we remember from yesterday, is outside the critical value. The critical value, we remember, it was minus 1.96 and 1.96. So whenever it is below minus 1.96 or above 1.96, then it's significant. And we see this is also correct. It's the short side that is responding. And the third hypothesis that they test in the paper, because we have overpricing, yeah, you remember when it's overpricing, it should be the short side that responds, not the long leg. So what's going on here? So the return difference of the long leg, so now they do the same regression here, but they do it only for the long leg. Before that here, they did it for the short leg, but here in this, in the first, and on the left-hand side, they do it only for the long leg. And, oh. So they use the same regression, yeah? They do it 3 times. Once for the long-short strategy, then for the short leg only, and then they use the long leg only and regress it on these dummies here, yeah? And now here we use just the long leg of the strategy, and in this case, we do not want to reject the null hypothesis, yeah? Our initial assumption is that it should be 0, but we have to formulate it always in a statistical sense as a null hypothesis that it's 0. Yeah? So the null hypothesis remains the same here. And in this case, the spread from minus 0. We have to subtract 1.14 from 0.77, which is minus 0.38 for the failure probability. And the t-statistic is minus 0.81. So what happens here? We cannot reject the null hypothesis, and that's exactly what we want to do. We do not want to reject the null hypothesis because we say the short side, the long side of the strategy is not responding. And minus 0.81 is somewhere here. So if the null hypothesis is true, it's within the critical values. So we cannot reject the hypothesis that this return difference is statistically 0. Yeah, and in the exam, I asked once, okay, if you take the failure probability, what they state in the paper is true. The long minus short strategy responds positively, and it's the short side actually that has a negative correlation to movements in the investor sentiment, and it's significant, and the short leg does not respond. So that's basically what the initial 3 hypotheses are in the paper, and if this is true, if all of these 3 hypotheses are met, then you can conclude that the changes in investor sentiment is a partial explanation for this respective anomaly. That's true. So for the first one here, we would say yes, what they state in the paper is true. And some students, they are deceived, you know. They are deceived. So if I would take, for instance, momentum, and I would ask you, okay, do the hypothesis test. Formulate the 3 hypotheses. This is exactly what I will ask in the exam. Formulate the 3 hypotheses, and then I will give you one of the anomalies, and I will ask you, they write in the paper this and this, discuss it based upon this anomaly. So once I gave students momentum, and what you see here, the point estimate, if you just look here on the long minus short, so the zero cost portfolio, what you find is point estimate is 0.81, right? Oh no, this is table 3. I'm already on table 3. Okay, it's here. If we go to momentum, it's 0.93, the point estimate. So the difference between high and low sentiment of the momentum spread is 0.93% per month with a t-statistic of 1.64. If our initial assumption is true, it should be statistically significant because we want to reject the null hypothesis, right? In the first case. But now, it's somewhere here. The test statistic falls in the critical values. So statistically, the momentum spread is not responding to changes in investor sentiment. The return difference is statistically not different from 0 on a 5% level because it's below 9.80, 1.96, yeah? It's 1.64. So our first assumption is already not fulfilled. So,
if you ask these kind of questions, will you always provide the table or should we memorize?
You should memorize.
Okay.
You should memorize 1.96.
Yeah, but
the table, of course. You should not memorize anything here. You should just understand.
Yeah.
Don't memorize. Memorize is not for. This is not applied science school, okay? So you have to understand, and I will give you all the tables. But you know, what you have to know is when it's significant and when it's not, and what is our initial assumption. You know, so in the first case, we want to reject the null hypothesis. In the second case as well, it should be smaller and significantly smaller. So it should fall here into the critical value on the left-hand side of the distribution. And in the last case, we do not want to reject the hypothesis. So the point estimate should be, the t-statistic of the point estimate should be within these critical values here somewhere. And for the first one here, for failure probability, it's fulfilled, but not for momentum, for instance. Already the first one we cannot reject, as we would have the wrong inference. Yeah? So for momentum, we cannot conclude, or we cannot say, based upon that table here at least, we cannot say that changes in investor sentiment would be a partial explanation for the momentum anomaly. Because already the first assumption that we have are not fulfilled. Because the momentum spread is not co-moving with changes in investor sentiment. Yeah? Is it clear to everybody? And now we can go through all of these anomalies. And most of them, they are like the first one here, like the failure probability. Most of the anomalies, they fulfill these 3 criteria. Yeah? The spread is statistically significantly positive. The short leg is statistically significantly negative. And the long leg is statistically not different from 0. For most of them, this is fulfilled. But if I grab one of these anomalies where this is not fulfilled, where one of these 3 assumptions is not fulfilled, then we cannot conclude that investor sentiment would drive this anomaly. Okay. All right, this is clear now. We will go through this again in the exercise so that then you can also ask more questions, of course. But that's important because it always gets wrong. Usually I ask in all these exams, I ask the same questions since many years. And I don't know if you don't speak with the other students from the previous year. You don't speak with each other? You can at least say, "Hi, I'm Kulu," and then you can talk about the exam, and they will give you the information. They will give you the information.
They don't remember.
They don't remember?
Yeah.
They will remember my part of the exam, for sure. No, just kidding.
It's the more difficult one.
Sorry?
Like your part is the more difficult one in the exam.
Really?
Yeah.
I don't think so.
It will be like easier than this year.
Okay.
The question.
But my colleague Jussi Nikinen, it was many years ago that they don't have him as a lecturer, as a teacher.
Yeah.
So who knows? Maybe his part is more difficult than my part.
So that's the reason why you should make the question easier for us.
But I told you now what I will ask, so you can prepare. So, well, okay. So hopefully this is clear to everybody. So and what follows here are just robustness checks. The rest of the paper is robustness checks. So what they do now, they add in this regression here, yeah, here we have this dummies for high and low investor sentiment, and then they add the market factor, size factor, and HML factor as controls. And then they do the same again. They test again the first alpha, the return difference between the first and second alpha here, which gives you the return difference between high and low investor sentiment. And then they do it again for the spread, for the zero cost portfolio, and for the long leg. Yeah, same thing. So the conclusion should be exactly the same. And then you can go again through the paper here, and through each row, each of these anomalies, and then you can test again. Here we test the return difference of the long-short strategy. In the second here, short leg. In the middle, high minus low column, we test the short side of the strategy using this test regression here, and again the alpha H minus alpha L, or in my notation alpha 1 minus alpha 2. And then we test here on the left-hand side of the table, we test the long leg only. Yeah. So, and again, first hypothesis, we want to reject the null hypothesis. In the second, if we use the short leg, we also want to reject the null hypothesis. But in the third case here, we do not want to reject the null hypothesis. So then, table 4. So in order to make it like very clear, so I mean you should maybe write it down. I don't know. So this is our pair of hypotheses for the, where's the cleaner here? Ah, here. Just to make it crystal clear. Yeah. So if we test the long minus short strategy, so the zero cost portfolio, which is in table 3 or table 2, yeah, it's on the right-hand side where it says long minus short. Yeah. So high minus low is the return difference. And here we can also add controls, yeah, as we have in table 3. We have here plus controls, and as controls variables we have size spread, market portfolio, and the value spread. Yeah, and in the first case we assume, or we would like to that the spread, that the return difference of the spread is larger when investor sentiment is high. So we formulate it as alternative hypothesis, and we want to reject our null hypothesis, and under the null hypothesis, the return difference is 0. So this is for the first part. So if we test long minus short, this is our hypothesis pair if we test long minus short. Second, we use only the short leg here in the regression. Do the same regression, and again, we test the spread, the return difference, sorry, of the short side. So alpha 1 minus alpha 2, or in his notation, it's alpha H for high minus alpha L for low. And it should be negative. It should correlate negative. It should correlate negatively with the changes in investor sentiment. So the return difference should be negative. And we again formulate it as alternative hypothesis because we want to reject the null hypothesis. So as null hypothesis, it remains the same. We say, okay, there is no return difference between high and low investor sentiment. And in this case, what we would like to, if our initial thought is true, we would like to reject the null hypothesis. This is for the second case. Yeah? We are now here in short leg. And for the first one, this is fulfilled. And for the first one, this is also fulfilled. It's the return difference between high and low investment sentiment from the short leg is negative 1.07, with t-statistic minus 2.19. So the t-statistic is somewhere here in the distribution, so we can reject it, and this is also what we want. But in the third case here, if we take the long leg, we again do the same regression. It's always the sama juttu, as we Finns say, sama juttu. Yeah? It's long leg here. Same regression, and again we test long minus the high minus low investor sentiment, but then our pair of hypotheses looks similar, but we have to exchange this here. Now it's unequal to 0. Yeah, our null hypothesis is now that the return difference is 0, and in this case, we do not want to reject the null hypothesis. Yeah, we do not want it. We want that the point estimate here from the long leg, it should be within the critical values. Our test statistic should indicate that the point estimate is statistically not different from 0, because the long leg shouldn't respond. If we have overpricing, we said, you might remember that, it's only a short leg that responds. And it should respond negative, because negative minus negative is positive in our zero-cost portfolio, okay? Just to make it crystal clear. But that's basically the correct way to set up the pair of hypotheses, okay? And yeah, if you use control variables or not, what you see in the paper, the outcome is basically the same. There's no big difference. Yeah. This is table 3. And then they do in table 4, they regress the zero-cost strategies and the long leg and the short leg, as you see here. Long leg, short leg, long minus short. No, where's the long minus short leg, by the way? Yeah, here. Long minus short leg, and here's the long leg. So, and they regress it basically on the investor sentiment at time t minus 1. And here you see, here's something strange going on, because if the initial hypothesis, the assumption would be correct, the loading of the long leg against the lagged investor sentiment should be statistically not different from 0. But in this case, the point estimates are negative. They're even negative. And here, some of the guys, here, this one here, for instance, is minus 2.38 for momentum. And the parameter for investments to asset is minus 0.70, with t-statistic minus 2.46. It's statistically significantly negatively even. It's even worse. Yeah. So in this case, our initial assumption is not confirmed by this table here, okay? At least not for momentum and for investments to assets, yeah? Because here's already an error. And also what we see here is the long minus short strategy is actually not responding. It's not correlated at all. It's statistically, the point estimate here from investments to assets is 0.07 of the long short strategy, and the t-statistic is 0.49, which indicates it's statistically not different from 0. So it's not responding at all. So this table here, table 4, does not support the initial thoughts about overpricing, okay? Then in table 5, they again control for the market factor, size factor, and value factor in this regression, and also here using the investor sentiment at time t minus 1. And what we see here, then some of the point estimates change. Luckily, also the long leg here becomes, on average, more positive than negative. And this table, in table 5, it seems to confirm the initial thought. In the exam, I could also ask you, of course, if I want. So table 6 is not important. And table 7, I could ask you, for instance, in table 7, they do the same thing, but they're using actually the risk factors, the initial risk factors, that is the size factor, book to market factor. They use a liquidity factor and the betting against the beta factor. And they do the same thing actually also here. but here something weird is going on. And you can think at home, if I would ask table 7 in the exam, and if you would use our hypothesis here that we were discussing all the time, and their assumptions, this overpricing, what they actually want to test in their paper, how would you conclude for these anomalies here, or for these basically factor spreads? If you would do the same hypothesis test, and you take the long line short leg, the short leg, and the long leg only in association with their assumptions, how would you conclude? Does investor sentiment, is it a partial explanation for these 4 factor spreads? All right, I think time is over. If you have any questions, you can ask now, otherwise tomorrow. And have a good afternoon then.